All right. Thank you, everyone, for attending this month's market update webinar for the month of November 2025. Let's begin with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can read up on additional disclosures on our website if you're so inclined. And throughout the webinar, feel free to submit any questions you have using the Q&A button at the bottom, and we will address them at the end. Quick summary of who we are. Silverstone Financial is a fee-only fiduciary independent wealth management firm. We provide various wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And my name is Jeremy Eppley. My partner here is Gordon Achtermann. We're both financial planners. I specialize more on the inheritance optimization, gift and estate planning side, and he specializes more on retirement planning and values-aligned investing. So if any of that is interesting to you, feel free to reach out to us. Let's hop right into what the markets did this past month. For those of you that are new, that haven't seen this graphic before, this is called a heat map. It's my preferred way of looking at the market. I usually have this on my second monitor most days. And how you read it is it's separated into the 11 different sectors of the economy, technology, consumer cyclical, healthcare, financials, and so on. The larger the square, the larger the company in terms of the value of the company. The greener the square, the higher the return it had for the period. The redder, the larger the losses were for the period. And the beauty of looking at the market in this way is that you can see clumps of green and clumps of red. It kind of shows some correlation in how different companies move, oftentimes in lockstep with their industries. So you can see this past month of October, semiconductor stocks did relatively well, whereas telecom, entertainment, some healthcare, some home improvement stocks, especially down here, basic materials, gold and such, gold mining companies, those did worse for the month. Going through some indices, which we have on the right here, the top 50 stocks in the S&P 500, so US stocks, were up 4% for the month, whereas the S&P 500 on a broader sense was up 2.3%. Our preferred way of investing is something called growth at a reasonable price, GARP, and that fell 0.9% for the month. So we see since mega cap companies, so the top 50 companies, being up 4%, and GARP, which is usually skewed more to the small caps were smaller companies and more value-oriented companies, those fell where these large tech growth names grew. So we've seen this year, every month or so, it'll flip back and forth between are the growth tech names taking off and money being taken away from some of the more value-oriented or smaller cap names, or some other months will be reversed, where the smaller cap value-oriented companies will be taking money from the larger companies in terms of market value. Global ex-US, so non-US companies, were up 1.7%. So kind of in line with what's been happening. It's usually moving up when the US companies are moving up this year. However, ex-US has been outperforming this year. This month was a little bit of a reversal. slight underperformance in comparison to US markets, but it is hard to say exactly with small caps. They were a drag on performance. Bonds mostly flat, slightly up at 0.6%. Gold continuing to have a good year, up 3.5% for the year, or for the month rather. And then Bitcoin, which we'll discuss more later, down 4%. We don't want to focus too much on these numbers. We could rattle off lots of these index numbers, but we're going to get into some reasons why these moves happened in a few slides. Anything to add, Gordon, here?
Jeremy, I'm curious, when you look at this on a daily basis, are you just looking to see, is there something happening today? Like, can you get this graphic just for the day?
Yes, yes. So any of you that are interested, it's finviz.com or .net. And it's the maps feature, and you can look at this daily, weekly, monthly, annually. There's also some other cool ways to look at this where you can set it up to look at PE ratios, that's price to earnings. So you can see that like financial stocks are usually having lower P's, which means they're more value oriented. Whereas like you can see Tesla has a forward PE of like 200, which means you're paying $200 for every $1 of earnings that Tesla has. So you can also see that clumping of where the value is in the markets. It's a really good tool.
Um, yeah, we don't recommend that you, our listeners, follow the market like every day. Studies show that not checking your account balances too often is usually a good thing.
Yeah, not
But
everyone enjoys it also, and is their
we
full-time.
look at it so you don't have to.
Yeah.
Let's,
Um,
let's look at the and year to date.
yeah, we'll fly through this. I don't want to just rattle off too many more numbers here, but you can see for those that are not podcast listeners that can actually see the graphic here, all not all, but very, very green, especially in comparison to the month graphic that we just saw. We see a lot more green. NVIDIA, Google, Broadcom, TSM, Oracle, all of these being up about 50% year to date. We also see global ex-US outperforming the US market. So non-US stocks up 27.7% for the year. And then the best investment on the screen here was gold at just shy of 50% for the year. So definitely an up year. And basically, if you held anything, it went up. The bigger question is by how much, and will that continue?
Yeah, really interesting to me how Amazon up 14, but if you go back to the prior slide real quick, yeah, 13% of that was in the last month. So a nice recovery there by Amazon, and I'll be mentioning them in one of the later slides about a deal with Anthropic, the AI company.
I believe it was Google that had the Anthropic deal.
But there's some Amazon news and context with that.
Awesome. Looking forward to that. All right. This is another graphic for, I do see a few new names in the chat. This is another graphic that I like to show each month. So there are two parts to it. The outer circle is the historical monthly returns for the S&P 500. This is from data from the 1950s all the way to the 2010s, 2017. And something a lot of people don't know is that the stock market actually has seasonality and cyclicality to it, where each month, there's an average where some months do better and other months do more poorly. The best known that a lot of people would be able to point out to would be the Santa Claus rally of that common end of year. What's causing it? Is it because people are happy, filled with joy, seeing their families and having good food and getting their Christmas bonus checks? Or is there some other underlying reason for the market to outperform systematically during that week period at the end of the year. Now, it's taking that same concept, but looking at it from a month basis and looking at it for the entire year. So that November, December, April being the three strongest months historically, and June, August, and September being the weakest months. Now, just because the averages show stronger or weaker months, that doesn't necessarily mean that any particular year will follow that trend. And what's really interesting is when you do line it up with what has happened actually this year, which is this inside circle, we see when the new administration was elected and brought in, February, March, April, there was a lot of turmoil, especially with tariffs and such, and markets fell. And then since then, it's been on a tear, especially sit through some of these weaker months of May, June, August, September. We saw some massive gains all throughout the year. Now, the big question, and Gordon and I both have discussed it in the past, of is it too euphoric? Is there potentially too much hype? Is AI a bubble? Who knows? Will this continue? Is the underlying question. And from a seasonality and cyclicality standpoint, November and December usually are good, which bodes well for a clean finish at the end of the year. But we've also bucked trends in previous months. So will we be diverging from historical averages? We will see. And I just love this graphic to help show where we've been and what is quote unquote normal.
Yeah, I love the Santa Claus rally. I think that people, um, if you need to take money out, a lot of times people will wait until January if they're expecting capital gains in order to have them on the next tax year. So like if you're taking money out every month, if you're a retiree or something, and then December, it's like, well, I'll just, rely on my savings and wait till January 2nd to take out the, um, the money I would otherwise have taken out in December. Little things like that can have a consistent impact.
And even for retail traders that don't might not think of that, a lot of the market is driven by institutional investors, hedge funds, and such, and they are even more cognizant and hyper aware of the tax impacts. So that will move markets, and they will be more likely to delay by a few weeks to be able to offset taxes by a year. For our listeners, it might be less likely that you would do that.
Yeah.
All right, so we have 3 slides worth of notable events that we're going to get into. I think Gordon's going to start out by talking some crypto news, which is definitely always entertaining.
Yeah, so where did my slide go? Paxos. So this is an interesting crypto story, and some of you who are wondering, like, why do we spend so much time talking about crypto? I think, one of the things that we strive to identify is sources of risk and things that are different than we've seen historically, or maybe things that our clients may not be familiar with. So, but anyway, Paxos issued $300 trillion of PayPal stablecoin. And so just to put that into perspective, that's more than the GDP of the entire world. And one of the strengths of blockchain, of course, is that the blockchain has to be validated by multiple sources that have the blockchain table on there. So this was identified and noticed immediately and corrected. And so on the one hand, wow, that's crazy that they did that. But on the other hand, no harm came of it. And it was caught. And so that's kind of like, okay, this was and if you were kind of testing the stability of a system, you might try something like this in a test environment and see, oh, well, what will happen if they accidentally issue $300 trillion of stable coins and it was handled. So I kind of feel like, well, we learned something there. Um,
It's interesting how
Go ahead.
you kind of see that the financial system with crypto has been a little more decentralized, where back in the day, the person that had the ability to quote unquote print money or just issue these kind of shares would have to go through either, if you're issuing shares, you're going through the SEC or some other regulatory body, or if you're printing money, that's the Federal Reserve, is government. And as more of these crypto companies have changed the status quo, where they say, well, why don't I just do this? Since there are more actors, there's more of a diversified number of institutions and individuals doing these things. We've seen in the past, and we will continue to see mistakes like this. And for some people, read that headline and that'll shake their confidence in the financial system and in crypto. And others, like how Gordon said, it might add some confidence, saying, wow, that was how did you add that many zeros extra on whatever you were doing? $300 trillion more money than's in the world, basically, but it being fixed almost immediately. It's interesting.
Yeah. When I worked at Freddie Mac, uh, I used to create wire instructions for the creation of mortgage-backed securities. And, it was a big deal if you were off by anything. Um, so
$300 trillion. You ever got that bad?
yeah. I wonder if anybody lost their job over that. Probably not. Um, so our next story about Bitcoin and cryptos, Bitcoin in particular, has had a big sell-off in the last month or so. And again, this kind of goes to headlines. The story was in Forbes on October 18th, and the headline says, Bitcoin suddenly braced for a massive 2026 crypto price shock after serious crash warning. And it's just so sensationalistic, just because of this one move doesn't mean that 2026 is going to be down. It's kind of gives the illusion of, oh, we think we know what's coming up next. But
Inevitability or certainty of, like, it's
yeah,
financial markets, you can't know.
right. But I was curious kind of, well, how how is Bitcoin doing relative to other assets? And so I made a little chart of, and I know you can't see it, so I'll just describe it to you. I went back to year to date and I compared Bitcoin to the ticker symbol VT, which is the Vanguard Total World Stock Index. So it's kind of just a proxy for just the whole world's stock markets averaged out by size. And um, so year to date, Bitcoin is up 7.66%, and the world stocks are up 19.71%. So, but Bitcoin has had this incredible volatility, right? And if you started just a couple of months earlier, like on election day, Bitcoin went way up in the week after that because of President Trump's promise to not to regulate crypto. And so, year to date is admittedly a very arbitrary uh, point, but uh, it just goes to show the volatility of of Bitcoin and cryptocurrencies, not necessarily tied to economic events, but rather tied to just investor psychology more than anything. Um, Our next one here, MasterCard, poised to acquire crypto startup Zero Hash for nearly $2 billion. That's an amazing price tag for a new fund. So Zero Hash is an infrastructure company in the crypto world. In other words, they're not customer facing. They are helping companies that want to utilize cryptocurrency and stable coins for legitimate financial purposes. And as we see more and more of the build out of blockchain technology, um, very valuable, potentially based on the ability to reduce costs and friction in the financial industry.
Yeah, and how you just said it, they work with the infrastructure. MasterCard Visa is a big infrastructure play for the entire financial system. And I assume they're trying to buy their way into or hedge their way potentially into the potential of crypto disrupting that. And they maintaining their position of, I just want to take tiny percentages of all the transactions and make sure everything runs smoothly. We'll see. It makes sense for, I don't know very much about Zero Hash, but MasterCard acquiring an infrastructure play, financial infrastructure play, makes sense for the company.
Mm-hmm.
All right, let's move on.
Okay, so I'm going to take this first one and then we'll turn it over to Jeremy. So Google and Anthropic. Anthropic is the owner of Claude AI, which is a competitor to ChatGPT. The two are really kind of neck and neck in terms of their efficiency and accuracy of their answers. But Anthropic has an interesting strategy in that this new deal is specific to Google, but sorry, I just lost my notes page. Here we go. But so Anthropic is now set up has a multi-vendor infrastructure. So this deal was for Google chips. Google has some chips that they design and make. And so Anthropic is running Google's infrastructure. They already partner with Amazon AWS clouds, and they use chips from Google now, in addition to Amazon's own Tritium chips and NVIDIA's chips. So similar to the way Microsoft has been like partner with everybody and become essential to the information technology infrastructure. Anthropic is partnering with multi-vendors. And when AWS went down the other day, we saw a lot of websites and probably some AI functionality that's dependent on AWS go down. Anthropic and Claude were still going strong because they were able to switch over to a different cloud. So they're building in multiple redundancy into their whole system, and seems like a smart move. Anthropic is not valued quite as highly as OpenAI, but I feel like they will continue to be a real serious player in this rapidly expanding industry.
Yeah, I think you make a good point around the Amazon AWS outage that happened either this month or last month, where a large chunk of systems across the country just didn't work. It was reminiscent of the CloudStrike burnout, the exact term, but everything broke and planes couldn't take off and such, where you have these companies that are providing the infrastructure to the internet and they have some sort of mistake and then everything comes crashing down. I have been seeing more and more of these kinds of headlines where having redundant systems with multiple providers so that they aren't reliant on a single infrastructure play. I'm sure it
Mhm.
has a whole lot of complexity on the coding side and the running side and the IT and all that. So there's probably additional cost to all of it. But from a making sure you have constant uptime and you have these, Anthropic is just like ChatGPT is used by other companies. So if you got, Anthropic is using AWS or Google Cloud or whatever, and then on top of that, there are other companies using their systems. If anything, any part of the pile gets pulled out, it's the Jenga, everything falls over. So trying to, instead of making a single tower, making more of a pyramid, you take one part out, it's not going to all topple.
Mhm.
All right, so I'll hop on some more AI news. ChatGPT. So OpenAI owns ChatGPT. That's the overarching company there, and they recently launched ChatGPT Atlas, which is their Google Chrome browser competitor. It caused when this was announced, I think halfway through last month, through October, Google shares had fallen 5% that day. Now Google has recovered since then, it seems, and overall, the Google is extremely diversified as a company. They have a lot of different product lines and such. Now Chrome definitely is one of their flagship portions of their business because everything runs through your browser. If you're trying to access the internet, you're using a browser, and Google Chrome has the largest market share out of any browser out there, which leads to other ways for Google to profit off of gaining information around you and serving ads to you. So OpenAI trying to challenge that, and it's definitely the markets take it seriously when OpenAI, when they had released ChatGPT, it became the most popular, fastest growing software launch ever. There's the fear that, okay, well, what if the same thing happens with ChatGPT Atlas and everyone stops using Google Chrome? It could definitely disrupt a large chunk of the market and Google's business. We'll continue to watch it. I haven't used ChatGPT Atlas myself. I don't know that many other people that jumped right onto that new train, but we'll see. It could definitely be a disruptor.
It's hard for me to imagine. Well, right now, AI has a higher electricity cost. Chrome and the Google queries, Googling things are free. I just wonder, can they, obviously they have a lot of revenue, but it seems like it would be more of a money loser than Chrome is for Google. Might have a higher cost component, I guess. We'll
Yeah,
see.
perhaps. I think the main part is it's just trying to get market share. All these companies, money's being thrown at them left and right. $1 billion here, $1 billion there from
Yeah.
whatever. The cost doesn't seem to be the main worry, which is brings up the worries of potential bubbles, like is this sustainable and such. But if OpenAI is able to siphon away 20% market share from Google Chrome, if 20% of all people use your browser to access the internet, I'm sure they can find a way to make some money off that. Just the question, will that happen? And like you said, how much will it cost them? One of the ways that they're trying to fund these big ambitions is a potential IPO. So OpenAI, same company that runs ChatGPT, there are reports that they're considering raising around $60 billion. So that is selling $60 billion worth of shares at a $1 trillion valuation. It would make it the largest IPO by a lot, I believe. And if this happens, it could shift a lot in how the markets work. One thing that a lot of retail investors don't take into account, when deciding, how to value a company or how to value, is the market overvalued or undervalued, is the inherent supply versus demand of stocks. Like as soon as $60 billion worth of additional stock just falls into the public markets, that does change the inherent, like there are more stocks available. So, OpenAI could do whatever it does, but it could actually have a detrimental effect on the market as a whole, as companies, institutional investors, whoever sell, it could come from cash, it could come from treasury bills or whatever, but a lot of the times they will equal weight out. Like if a Vanguard, for example, their market passive market cap weighted managers, a lot of the stock market and money management is passive market based. As soon as a $1 trillion company suddenly becomes public, they have to equal weight things, which means selling a little bit of every single other company to buy this $1 trillion company. So you can see the entire market the day that the days, it could take a week perhaps to filter everything through, but the day the IPO happens, OpenAI might be crazy and do awesome, and if you're able to get into the IPO, you can make money. But I wouldn't be surprised to see the rest of the market be all red, just to try to compensate for the change in IPO status.
That's a great point. Wow. Yeah, $1 trillion, or 600 billion. Um, yeah, all the indexes will have to will have to buy up. Um, who knows what could happen? That'll be an interesting thought experiment if this starts to come through to model out, like, okay, how much could it go up
Yeah.
in the initial day when all the indexes have to buy it at once?
Let me look. Value of US stock market. So the total value of the US stock market is over 50 trillion off of a first Google search. This one right here says 67 trillion. So if you divide, again, this is just a Google search, I haven't double checked any of these numbers, but if you divide a 1 trillion divided by 67.8 trillion, you're looking at how much? 1.5% drop in the entire market to accommodate for an additional $1 trillion company, because you're inherently changing the total value of the market as soon as that becomes from a private to a public company. So yeah, it could definitely shift the companies that are more, high beta companies that are more subject to market volatility could be disproportionately hurt. So it depends if there could be a spiral effect with all these different companies that are interwoven, where you have all the NVIDIAs being buying into OpenAI, buying into other software, AWS, the cloud, Amazon cloud, and then just a cycle of money going back and forth and the concentration going back and forth. We'll see how it all works, but there's definitely a lot of concentration risk, which we try to mitigate for a little bit in our managed portfolios, where we do a portion, about half of U.S. company assets in GARP, growth at a reasonable price, which is less commonly invested in and doesn't make up a lot of the market cap passive weighted indices. So a lot of my concerns come down to a lot of the passive, NVIDIA is making up 6% of the S&P or whatever it is right now. Like it starts getting very concerning. All right, moving on to the last slide here. This is a more fun one, at least for me. Looking at the attendees, this might not be where most of you have experience, but definitely for the younger demographic, there's a lot of, let's say my friends are really into video games. And different video game companies find different ways to generate revenue. And one of the more common ones is to have a free game or an inexpensive game to buy. And then those that really enjoy the game, they will go and buy cosmetics. So like their hero can have different clothes, or a common one is skins for whatever weapon you're using, if it's a shooter or some sort of like sword-based game or whatever it ends up being. And so most of these games and companies decide to be the counterparty to these transactions, which, they design the cosmetic, they sell the cosmetic, and it's just an interaction between the company that makes the game and the consumer that plays the game. Now, there's a few other games that handle it differently, and they handle it via a public market, where Counter-Strike 2, they are a video game that is a first-person shooter game, so they have guns and such, and you can buy various cosmetic, what they call skins, for their guns, or the character's gloves, or the character's knife, or something like that. And then you can trade it, sell it between different other players. You can even gamble it. There are entire sites that you gamble the monetary value of these skins. It doesn't matter exactly how it works. The underlying point of the story, why we included it, is it's an unregulated public market that had about $4 billion worth of these skins. This kind of acts very similarly to cryptocurrency, where it's unregulated. Some private company is issuing these essentially tokens that have value that people trade between each other. However, this gaming company is called Valve. They run the largest video game marketplace called Steam. So Valve owns Steam and Counter-Strike. And Valve changed how the skins could be what's called trading up in the game, where you could use 5 lower tier skins and you can trade it up to 1 higher tier rarer skin. And essentially what they did is they changed the settings behind the infrastructure for the game, and it allowed these really rare, difficult to find skins to become more abundant. And this was a change. They switched it overnight without warning, and it wiped out 50% of the market value of the rarest skins in the game. And it was $4 billion worth of total skins, and about 2 billion was wiped out overnight. People lost. It's shocking. I don't recommend it, certainly, but there are people that have tens of thousands of dollars worth of skins in a video game, so like they could have lost tens of thousands of dollars overnight. So it could definitely be impactful, especially there are some people that speculate and trade the markets literally. So it had impact.
But correct me if I'm wrong, but it's not like Valve gets that money. It was all just in theory,
Yes.
kind of on paper.
Yeah. So how Valve works is they have the marketplace. So they make a penny or two per transaction. So they make lots of money. They also sell the skin, basically, they're called cases, and you randomly get skin. So it's probability based. So the hardest to find skins are probability based. And instead of only being able to get the hardest to find skins through probability, you're able to trade up lower tier skins into these only probability based skins. It basically just changed the dynamic of the distribution of rarity. So it shook the market. And again, it doesn't necessarily have to do with anyone on the call or the stock market itself, but the underlying story, I find it really interesting. And it brings up the idea of, there is underlying risk no matter what kind of market you're in. And a single news headline or a single change in how the system works can dramatically overnight change the value of the markets. So a lot of, if you look at the last news story that Gordon's going to touch on, is how the US has the most amount of extremely valuable companies. There are a lot of reasons for that, but one of them is that the US is inherently seen as having a structural advantage, and that makes their companies more valuable. There are other reasons, but that's one of them. For whatever reason it changed, where oh, we're no longer paying our debts on our national debt, or our companies are no longer really able to do international trade because of various currency controls or tariffs, let's say. It could overnight one day say, oh, well, perhaps there shouldn't be this risk premium, or there should be a risk premium attached to it, and there shouldn't be this value premium attached to these companies, and it could overnight switch it. So it's not to scare anyone, and it's not to say that's guaranteed to happen. Definitely not. But it's interesting to see how the underlying inputs and assumptions that drive and build up the valuations that make any market. So, the only way markets work, and the only way the currency works, or money or value works, is that other people believe it has value. If any underlying assumption changes, it can have leveraged extremely, the magnitude can jump up. We saw that in 2008, where we had all the credit default swaps and the various iterations of default swaps and default swaps that were just betting on betting on betting that blew up the financial system. You can have the same thing with underlying assumptions. Yeah, I don't know if I read too far into that story, but that's where my brain goes when I when I hear about some video game skins getting less valuable. All right, a few other ominous stories, and then we can move on for the night. Stocks sink on concerns about regional banks exposed to bad loans. This was a short-term headline that popped in and then popped out pretty quickly. But it's earnings season right now for the stock market, so all the different companies are saying how well they did the past quarter. And there were a number of banks, I think it was Western Alliance here and Zions, that had some bad banks, or some bad loans rather, that were subject to some low quality borrowers, and they were announcing that they had some losses and or some potential losses, that they were worried that these might not get paid back. And the market took that really badly in those few days around when those that news came out, because it's the common saying in the finances, the canary in the coal mine. You're looking for some reason to get out before everyone else, because this is the proof that everything is going to start falling down, and that there is underlying contagion in the stock market. Now, other banks continued to have their earnings, and other banks didn't seem to have that same problem. There were some concerns, but it wasn't a systematic problem that a lot of analysts were worried about. So we're going to continue to watch it. Gordon and I are more concerned than say a year ago about the valuations in the markets. So it wouldn't be surprising if we start seeing cracks in the economy. But as of right now, nothing seems super contagion, especially with bank loans. These regional banks had specific types of customers that were somewhat concentrated in their special niches, whatever the banks were doing. And it seems to be one-off events, not necessarily bad loans across the board. But we'll see if that continues to be true. And then I just want to throw this in, this news story here. The government shutdown, as of I believe this morning, this afternoon, it's officially become the longest in U.S. history. Of course, a lot of this comes down to a fight between the Democrats and the Republicans over differences in opinions around healthcare and what should be subsidized versus not subsidized. And of course, the election we saw last night, where we saw a Democratic sweep. It shows that a lot of the U.S. Has been displeased with how the administration has been handling things. So we'll see if that has an effect on the government shutdown, whether it either emboldens Democrats to hold their ground, or if it weakens or brings some more Republicans to be willing to compromise. We'll see. It could just make them dig in deeper. Who knows? Anything to add there, Gordon?
Well, just that it's, it's particularly painful in this area. Maryland
Maryland, Virginia.
has been hardest hit, has the most federal employees affected, and Virginia very close behind. So yeah, it's kind of personal for people who have family members and neighbors, who are especially those poor air traffic controllers who work already incredibly stressful job. And there was a crash in where was it? There was
Yeah.
um what was it, like a UPS plane or something that crashed?
Yeah, I saw that just a few days ago.
Yeah.
Yeah.
So you do worry about that. Uh,
Louisville, Kentucky.
yeah.
12 killed. Yeah.
And they're saying that this holiday season will be the worst travel day in US history if the thing is still going on, because uh just
That's
because of the
exciting. I didn't know that.
chaos in in the airlines.
Well,
Um
I have vacation coming up. I didn't think that so much about the impact of my vacation. I'm sure that'll make it so much more enjoyable. Uh,
yeah. Yeah, I would allow a little extra time getting to the airport a little extra early.
yeah.
Um so our last thing here, the US has 20 of the world's 25 most valuable companies. And I think that there's um there's something to be happy about that from the point of view of the US. Um I think it's also interesting because more than other places, the United States has more of a winner-take-all culture. Um, there was a book in the 90s about the shift in American culture that went into pretty high gear in the 80s and early 90s, and has just, been solidified since then. Um, you know, in Europe, in Germany in particular, they don't like companies to get too big. They don't like a concentration of economic power. Um, unless there's a really clear advantage to scale. And so the biggest companies in Germany are car companies where that manufacturing capacity is, it's hard to dispute the advantages that that size provides. Drug companies also in Europe tend to get pretty big, but other industries are regulated to keep companies from merging as easily. And, um, you know, so we have these big companies, but the European stock market as a whole this year is up. The Eurozone is up 34.47% as of this evening when I just checked that. Um, Despite only having one company in the top 25, which is
ASML.
ASML Holdings. And I had to look up what they do. They're like a chip lithography company. So they basically they provide the machines that the chip manufacturers use and the design, work on the design of chip manufacturing. And um, they're a Dutch company.
Yeah. The
Um,
semiconductor industry is
yeah,
crazy if you think about it. Like ASML, they sell like $300 million machines. Like a single machine is that much. And so
wow.
ASML usually their biggest customer is TSM, so Taiwan Semi Manufacturing, and NVIDIA, AMD, Broadcom, Google, Samsung. Maybe not Samsung. I think Samsung has their own fabs, but almost all of them, they just design the chips and TSM manufacture them for it. So ASML produces the machines to make the chips, and
Right.
they are, by some accounts, the most intricate things humans have ever made. You know, you are making something that has to be under certain conditions that manufactures various semiconductor components that are microns thick, and you do that consistently and constantly, and it's a mass production. It's very insane.
And they double the number of
Transistors.
calculations per square inch or whatever every couple of years. Um, and there's so many companies, excuse me, in research trying to figure out whole new ways of storing data on the chips because of the value and concentration of market share with this one company.
Yeah.
Um, yeah, I looked up, that article was a few days ago. Um, who's right behind Costco? Well, as of today, sorry, who's right behind ASML? Well, it's Costco.
Mm.
Um, today is number 25 and ASML fell to 26. So, it could be some other company other days, but the next best, biggest European one is way down at number 33.
Novo Nordisk.
LVMH.
Oh, that's Louis Vuitton. Yeah.
Yeah. All right. So French, luxury goods company.
I know Novo Nordisk. That's the one that does Ozempic and Wegovy, or that's
Yeah.
the weight loss drug one. That's the largest company in the Netherlands, I believe, or something like
Well,
that.
it can't be the Netherlands because
Okay, then it's maybe it's Belgium or the Dutch. No, I don't know. We'd have to look it
yeah.
up. But they're a massive, massive company.
Yep. So, that's all I've got on that one. Really interesting though. Just the cultural, how culture affects the way that things kind of shake out for how our industries are structured.
Yeah, definitely. All right. Well, um, we had pretty good attendance today, but I didn't see any Q and A's. The only one I see is someone being excited about LVMH, which Louis Vuitton, something Hermes, I assume, or I forget all the four words, but it's a amalgamation of different luxury brands. Um, I forget if the owner of it, it's a family, but the patriarch, I think he was the richest man in Europe. I'm not sure if he still is. But yeah, it's a wonderful webinar. I had a good time. Thanks. I'm glad that Gordon's here with me. It's better than a year ago when I was lonely and doing this for half an hour monologuing. Uh, but
And and I appreciate everyone's patience with my cough.
I think you did a pretty good job at muting. So a lot of
Thanks.
people probably, especially those that don't have video, they're on podcasts that only um, only could hear, had no idea that you were coughing. So all right. Well, thank you, everyone. Next month is not our normal time. I think we are meeting December 9th, which I believe is a Tuesday, due to vacations and travel and such. So that'll be our last webinar for the year. And then January will be our special year-end recap wrap-up webinar. So hopefully we'll see you at those two events.
Yeah, we'll have to come up with a name for the yearly wrap up.
I think
The
I
year,
used to call it like year in review or something like that.
not still Silverstonapalooza.
That'd be good. I like it. All right. Everyone, have a great night. See you next month.
Good night, Jeremy.
Okay.